Have you ever looked at a company and wondered what's really going on inside? You know, past all the flashy marketing and the polished press releases? If you want to see the real story, its health, its struggles, its triumphs, you need a financial x-ray. And that's exactly what we're going to learn how to read today. So, what are a company's deepest secrets? I mean, where is the money really coming from? And where is it all going? Is it actually thriving, or is it just barely hanging on? The thing is, the answers aren't locked away in some secret vault. They're written down, right there in plain sight. You just have to know the language.
And that language is accounting. Seriously, think of it as the universal grammar of business. Every single company on the planet, whether it's the coffee shop on your corner or a massive global tech firm, speaks it. It's the system they use to tell their financial story, plain and simple.
Okay, I know, that definition sounds a little dry, a little academic, but here's the key takeaway. Accounting isn't just about throwing numbers around. It's a really methodical process. It takes every single financial event, every sale, every purchase, every single paycheck, and organizes it all into a clear, understandable story. And take a look at this. It shows you the whole process in action. Over on the left, you've got the raw data, the inputs. That's all the daily chaos of business, right? Sales slips, bank records, payroll. Then, in the middle, all that data gets processed. It's recorded, it's classified, and it's summarized. And what pops out on the right? The outputs. Those clear, powerful financial statements that tell the company's true story. So, let's talk about those outputs. Because when we say we're going to read a company's financial story, what we're really talking about is understanding three key reports. You can think of these as the crown jewels of the whole accounting process. First up, you've got the balance sheet. I absolutely love this analogy. It's a snapshot. It literally freezes one single moment in time and shows you the company's financial position right then and there. Then you have the income statement, which is more like a video. It shows you how the company performed, its profits and losses over a whole period, like a quarter or a year. And finally, the cash flow statement, which tracks the lifeblood of any business, cash itself.
For this explainer, we're going to zoom right in on that snapshot, the balance sheet. And you might be asking, why start there? Well, because it's the absolute foundation. It is the starting point for understanding a company's fundamental financial health and its entire structure.
Now, to decode the balance sheet, you really only need to understand one core concept, and it's an elegant, powerful, and totally unbreakable rule that governs, well, everything in the world of accounting. And here it is, the fundamental accounting equation. Assets equal liabilities plus owner's equity. It's actually beautiful in its simplicity. See, everything a company owns, all of its assets, had to be paid for somehow, right? It was either funded by borrowing money from other people, which are its liabilities, or it was funded by the owners themselves, which is their equity. That's it. And that is why we call it a balance sheet. The two sides of this equation must always, and I mean always, be equal. What you have on the left, the assets, has to perfectly balance with how you paid for it on the right, the liabilities and equity. There are absolutely no exceptions. It always balances. Okay, so let's get practical. Let's pull this equation apart and take a look at what each piece actually means in the real world, starting with the left side of that scale. Assets. So assets are all the valuable things a company owns. And as you can see here on this sample balance sheet, they're usually organized by how fast they can be turned into cash. At the very top, you have your current assets. This is stuff like cash itself or things that are going to become cash within a year, like inventory. Down below that, you've got the fixed assets. This is the heavy-duty stuff like land, buildings, and equipment. And sometimes you'll see intangible assets, things you can't really touch but have huge value like goodwill or brand reputation. All right, let's hop over to the other side of the equation and see how all those assets were funded. Liabilities are what the company owes to other people. Basically, it's debts. And just like assets, they're broken down by time. First, you see the current liabilities. These are debts that are due within 1 year, like payments you owe to your suppliers. And hey, here's a little pro tip for you. A healthy company usually has way more current assets than current liabilities. It's a good sign it has plenty of cash to cover its short-term bills. Below that, you have your long-term liabilities, like a big multi-year bank loan. So, what's left after you take all the assets and subtract all those liabilities? Well, that's the owner's equity. This is the owner's actual stake in the company. It's their piece of the pie, so to speak. It represents the value that would be handed back to the owners if the company sold off all its assets and paid off all its debts. It's the true net worth of the business from the owner's point of view.
Okay, so we've been talking about the company's liability, what the business owes. But what about personal liability? This is where understanding the numbers on a page can suddenly have very real and honestly, sometimes very scary consequences for the people behind the company. Let's look at a pretty high stakes legal twist. You see, in a lot of common business structures, there's this amazing protection called limited liability. You can think of it as a legal shield. It means that if the business goes under, the owners are usually only on the hook for the amount of money they actually invested. Creditors can't come after their personal house or their car. It's an incredibly powerful protection, for sure. But, and this is a big but, it's not absolute. There are some very specific situations, loopholes you could call them, where that shield can just completely shatter, and an owner can suddenly find themselves personally responsible for every single penny the company owes. And here are 4 big ways that can happen. First, if you promise to invest a certain amount but haven't paid it all yet, you're liable for what's left. Second, if the business starts racking up debt before it's even officially registered with the government, you could be fully liable. Third, if you're a limited partner but you start acting like a manager, making big decisions, the law might treat you like a general partner with unlimited liability. And fourth, in cases of outright fraud or abuse, the courts can pierce the corporate veil and go right after your personal assets. The bottom line is, the rules only protect you if you actually follow them. And that brings us right back to the big picture. You see, understanding a balance sheet, getting your head around concepts like assets and liabilities, this isn't just some academic exercise for accountants. It's a critical skill for anyone involved in business, investors, managers, and especially owners, so you can make smarter, safer, and way more profitable decisions.
So now you have the key. You have the tool to unlock the true story behind any business. You know the language. You can look at a balance sheet and see not just a bunch of numbers, but a real story of strategy, of risk, and of value. So the only question left is, what stories will you uncover?